RIAs historically, like you said, Adam, have been reticent to branch beyond the traditional 60-40 portfolio of stocks and bonds. To entertain alternatives, let alone to make allocations to alternatives, has been groundbreaking over maybe the past decade or so. I think where T2 differentiates in our ability to kind of break down some walls and to get into the RIA space early. I hate to really boil it down to something simple, but I think it's two things. Number one, I think people learn to trust us. Secondarily, it does come down to results at the end of the day. I can trust you, I can invest with you, but you've still got to deliver. We have delivered through the years.
Hi, Adam Gower here, founder of GowerCrowd.com and host of this YouTube podcast series, Real Estate Market Watch, current events through a real estate lens. My guest today is Jeff Brown, who is founder and CEO and co-chief investment officer at T2 Capital Management in Illinois. He founded the firm in 2011 on the heels of the global financial crisis as a debt and equity shop, acting as a bridge lender and also as a principal owner operator of multifamily and student housing. Their assets under management are around $1.4 billion today. And one of the things that really makes T2 and Jeff stand out is that of their primary capital source actually is through RIA or registered investment advisor channels, wealth management channels. That's unusual because it's notoriously a very difficult channel to raise capital from, actually, for sponsors. So something really sets Jeff and T2 apart, and you're going to learn a lot about exactly what that is in today's conversation. If you have not already subscribed to my newsletter, go to GowerCrowd.com. There's a big button top right that when you click it, you'll see who other subscribers work for. Some of our subscribers' companies' names are listed there, so take a look at that. You can always unsubscribe. And in the newsletter, I share details of these conversations with Jeff and with other podcast guests, as well as tips and tactics, really, advanced tips and tactics for optimizing any capital formation efforts that you are engaging in at the moment. All right, all there at GowerCrowd.com. All right, let's move on to Jeff Brown of T2 Capital Management, coming right up. Jeff, what a pleasure to meet you. Thanks so much for joining me on the podcast. I had a look at your website. It's a really interesting website. And you have an interesting business model. You started post-global financial crisis, and you've evolved somewhat since then. So I think just at the very top, tell me more about T2's core business model and investment thesis. Why don't we just start right there? And also scale as well.
Sure. No, it's a pleasure to be here. Thanks for having me, Adam. Yeah, we were started in 2011, like you said, on the heels of the great financial crisis. A lot of people will ask me, oh boy, what's it like to be an entrepreneur and start your own company and whatnot? And I always come back to the old saying, necessity is the mother of invention. I was working in commercial real estate. The world was on fire. Capital was extremely sparse. I was getting my MBA at the University of Chicago at the time. And I honestly didn't know if the firm I was working with was going to survive. And so kind of shared my tale of woe with a couple of professors, and they turned me on to this notion of private equity, which ultimately, to keep a really long story short, gave rise to T2. So we're a private equity real estate firm. Mm-hmm. We manage about $1.4 billion today. The vast majority of our capital comes through RIA channels, high net worth folks around the United States. We have just shy of 2,000 investors, to put that in context. So it's a lot of work, but the company, since 2011 has been grown organically. There has been no M&A activity through our almost 15 years now, and so it's been a great ride. 22 of us on staff. I'm sitting here in suburban Chicago at our headquarters. We have an office in Nashville, Tennessee, as well. And like I said, it's been great. We're certainly looking to scale, but have had a great run over 15 years now.
Okay. Gosh, I'm so happy that you said that. What an interesting story, actually. So you are not unique, but you're definitely in a very small subset of sponsors. And I'm going to get to exactly what I mean by that in a moment. You may not know it, you might know it, but I certainly know you are. But sometimes you can't see if you don't see right when you live in a bubble, or not in a bubble. When you live in your own world, you don't know actually that much about what other people are doing. So I'm going to share something with you. I'm sure you may know already, but anyway, before we get into that, what do you invest in? So let's talk about it.
Sure.
'Cause I know you've got debt, equity, or asset class agnostic. Just describe to me what the investment thesis is and how do you deploy $1.5 billion of equity?
Sure. So three distinct verticals, and this has been an evolution over our 15 years at T2, but three distinct verticals is where we've landed today. Far and away, our most active vertical is in the private credit side. So we're a very active bridge lender in the commercial real estate space. That goes
Hmm.
all the way back to when we started. That is my core competence individually. So we make loans of roughly $3 to $30 million on transitional assets, all property types across the United States. Our bread and butter is, say, the proverbial 10 to 15 million dollar loan in the Midwest or in the Southeast. So sticking kind of close to where our offices are located, and with a lot of repeat borrowers. So that's been a great run for us. A second vertical is in the student housing space, in which we own and manage properties. So very different than the debt side. So we own, manage student housing properties, again, in select markets around the country. One of our key differentiators at T2 is that we're really not coastal focused. The joke internally is that we run along the Mississippi Bank. So, you know, again, very active in Big Ten type schools, SEC type schools. And then our third and final vertical is in the multifamily space, and that's again owning and managing properties there. So as markets ebb and flow and whatnot, certainly we kind of emphasize one vertical over another, but we have learned the discipline of being experts in a given niche within the commercial real estate space, as opposed to trying to be all things to all people, which is where I've learned some valuable lessons early on at T2.
Right. So your PR team asked me to send a list of questions that I'm going to hurl out of the window now.
Oh, okay.
They'll be delighted to know
Of
that.
course.
All right. So, bridge lending. What an interesting asset class. Okay. So, that has been the topic of a lot of discussion in the last few years. A lot of bridge lenders have really struggled. They were very, very aggressive in what, 4 years ago, 5 years ago. And I've had some deep discussions about the struggles that they've been having. What has been your approach to bridge lending? Actually, first, why don't you define for that one person who doesn't know what a bridge lender is? But what is your approach to that, and how have you found the market over the last few years? Well,
Sure.
hmm,
So first, I would define bridge lending as really trying to take a transitional property, so something that might not yet be stabilized, might not be ideal to sell, might not be ready for a long-term takeout loan like a CMBS or life insurance company loan. It needs some help. Maybe the existing lender, the bank, has some fatigue. So there's generally a story that accompanies each bridge lending opportunity. For us, we structure our loans to stay consistent with being a bridge lender to 3 years and in. So again, we're not here to be a long-term solution on the capital side for borrowers, but we are here to help people get from point A to point B. When we first got started in bridge lending, again, going back to the inception of T2, we were in this bucket where it just wasn't near as populated as it is today. But a lot of people would call the space a hard money lender. And I always hated that connotation. We work really hard at T2 to be solutions oriented, to be collaborative, to be a good partner for our borrowers. Even though we're not technically capital partners, we want to help people to get from A to B. We're not there to set tripwires, claim a definitive default, make a move on the collateral, anything like that. Certainly, we'll do it in the event that circumstances necessitate it, but we're here to be helpful and here to be a bridge. So that's a bridge loan, if you will, from T2's vantage point. Like you said, it has certainly grown in popularity over the past few years. Uh, Folks on our investor relations team today will say that there are a lot of tourists in the space at this point, which is to say a lot of people that have not been in the space historically are suddenly jumping in, trying to be active. They see the merits of being able to generate low double-digit returns on senior secured debt, which is a really unique, attractive risk-reward balance that we obviously really like and our investors really like. So we've just perpetuated that through the years. We have faced increased competition, but frankly, for us to play in that $3 to $30 million space, a lot of it is pretty fragmented, non-institutional, and so we do still have a pretty wide open field from a competitive landscape.
Okay, so let me ask you this then. So the tourists, and you're talking about the bridge lenders,
Correct.
the people who are competing directly with you, not presumably the sponsors who are new to the industry. And there's plenty of those tourists as well. But so what are the biggest mistakes that a novice, trying to think of the right word, novice
Yeah.
bridge
Yeah.
lender can make, and how do they create noise for you in the market that makes it harder? If you talked about more competition, what are they doing, and how do they affect your ability to compete? And what are the mistakes they're making that create for you frustration, presumably?
Sure. So I would say that the way that they most actively compete is on price. Just like any other industry, they come into the space, they want to make a splash, they want to scale, so they'll undercut T2 and others that have been in the space and maybe have a different perspective of a given loan opportunity. So they'll be awarded a deal simply because a borrower is seeking the lowest cost option on the bridge lending space.
Mm.
That's how they disrupt things for us. And again, we say it a lot internally. We get a lot of boomerang opportunities, is what we call them. So a borrower will go down the path with one of these novice sort of lenders, or these undercut priced lenders, and then there's a failure to deliver when, hey, a closing date is coming. Suddenly, loan documents aren't showing up. Um, there's
Mm.
some nuance that the borrower is suddenly uncomfortable with, and so they'll come back to us and say, hey, listen, I just need to close. I love this property. I'm willing to pay the premium for it. I'm planning to take you out in 6 months or a year or whatever the case is. I just need to close on this so that I can own and control this given asset. So the price is the major way in which the tourists or the novices of the bridge lending space will disrupt our market. Um, where we add value is we've been there, done that. What these novices I don't think fully appreciate a lot of times is the uniqueness that comes with certainly construction lending. Like, construction is hard, entitlement is hard, development is really hard. So an
Mm.
appreciation for what that process is, an appreciation for what documentation should be in place before construction draws are funded, that sort of process. But even
Mm.
outside of construction lending, again, I think there's a hypersensitivity, at least at T2, for what these borrowers, developers, owners are going through just to get to the closing table. And all we are is a piece of the pie for them. They just need capital to show up in the
Mm.
amount that we told them that it was going to show up, and on the timing that we said it was going to show up. They need to cross that off their list. So we're not trying to cause drama or noise or anything like that. We just want to be a reliable capital source for our borrowers. So that's simple. Again, it sounds simple, I should say, but it's uh,
Not.
not the case whatsoever. Not common. Yeah,
Exactly.
yeah,
I know. Actually, the greatest pros in the world make things look simple.
yeah.
I, 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 I find myself, I mean, I'm like self-aggrandizing, but I find myself describing what we're doing as actually being really simple. It's really easy.
Yes.
But it's not actually.
Yeah,
You
yeah.
know, it's after a long time of knowing what you're doing. So as far as just one last question on this bridge lending and this idea of
Sure.
newcomers into the industry.
Yeah.
So the most important thing is kind of the fiduciary responsibility that you have to your investors and your ability to pay them back. So if the only difference is that somebody is offering lower rates to a borrower, but it's a borrower you would like to lend to, then the only difference, and this is building up to a question, the only difference is that they're unable to offer quite the same returns to their investors, presumably, as you are. Question mark. Right? Is that the only
Sure.
difference, or are they also taking or layering degrees of risk that you are not? If you follow what I mean, like how are you mitigating risk with? Yeah, okay, so you do right.
Totally tracking with you, Adam. And I appreciate you bringing to light the investor perspective of all this, because all this sausage making that we do on the bridge lending side and whatnot, it is just that. Like, it's messy. It's very involved.
Mm,
Investors just again, we always say to T2, they just want to give us $1 and have reasonable expectations for how much and when they're going to get their return back. Um, one of the ways in which we do that, so we've got a very built out investor relations team. We go through annual audits. We our most active bridge lending fund is open ended, so we offer liquidity to investors. If they need out, they can get out. We've never had an issue not meeting a redemption request, even though we've had 1,700 investors in the fund. Reporting is key. Again, just where can the novices misstep? It's not only on the lending side, but it is on the investor reporting side as well. Communication, as you well know, is just paramount to what you're doing, good, bad, or indifferent. Again, it's a lesson I've learned the hard way through 15 years. Is even when there's bad news to share, you got to share it. You got to be open. You got to be transparent. And so we go out of our way to report at least quarterly, and to the extent that there's some newsworthy event intra-quarter, be proactive about sharing it. And so that's what we've done. It's been a material differentiator. And again, it's led to our sprawl to 1,700 investors at this point.
Okay, so let's move to these two owned asset classes. You talked about student housing and multifamily. So just very high level, these are value add or ground up? Let's just start there. What's the investment thesis
Yep.
approach?
Historically, we've done both. I think there's a season for each one. Over the past 2 or 3 years now, it's been extraordinarily hard to do ground up. Just the numbers don't pencil as easily as they once did. So we find ourselves more and more on the value add side of the ledger. For us in the student housing space, we are most frequently buying value add properties that are often bus to campus in lieu of walk to campus locations. We like being a low cost provider when it comes to providing housing, being in the student housing or the multifamily space. And especially as cost of college continues to escalate and people are questioning the affordability of it, being in that low cost provider for student housing has been a real unique and advantageous asset class for us. So that's how we look at and penetrate the student housing market.
Right. And multifamily? And this is all down the banks of the Mississippi, is it?
You got it. Yeah, the vast majority of our holdings are in Tennessee, Alabama, Florida, Georgia, and then back up through the Midwest. But yeah, multifamily, not much different. We've done a little bit more development in the multifamily space, but not much. It's hard. B and C class multifamily, it has its own set of characteristics that are distinctly different than Class A multifamily. And I would even say the same with student housing, but it's certainly accentuated in the multifamily space. From the standpoint of what does your tenant profile look like? What do collections look like? What do concessions look like? What does turnover look like when leases are up? And so, we're assessing each of that with each of our properties that we look at. Certainly, they're specific to each market as well. Trying to, can build scale and penetrate these markets that have material job growth, demographic trends trending in the right direction, population inflow. But again, we find a lot of solace in being a bit of a low cost provider in the market. Catering to workforce housing is what a lot of the market knows it as. But again, there's just a lot of nuances that come with that, where it's not for the novice. It's a hands-on. We say it's hand-to-hand combat when it comes to management of a lot of these various asset classes. And I hate to paint the picture like combat. Combat's not the right adjective, but it is very involved.
It's all right.
It's not part anyway. Right. It's a very full-time job.
Yeah. I mean, you're putting out fires all the time, most of the time.
All the time. Yeah.
It's basically, it's the business that we're in.
Yes.
But so what are the so you're B and C, are you? B and C value add, and occasionally you do some ground up. So what would you say the headwinds and tailwinds for these asset classes right now? Well, let's start with the multifamily. Yeah.
Sure. So I'll start with the tailwinds in the multifamily space. I saw some stats earlier this week. The average age of the first-time homebuyer in the United States just eclipsed 40 years old. That blows my mind. And it paints the picture of just how untenable it is for a lot of these younger folks in particular to get to their first house and accomplish the proverbial American dream. And so the tailwinds in the multifamily space are just how unattainable for sale housing is right now. So I love that aspect of the tailwind. And on top of that, in light of what I said earlier, it's been so difficult to do ground up development in the multifamily space, but in other spaces as well. But the kind of the governor on multifamily has really suppressed new supply in the market. So that suppression of new supply just exacerbates demand. So when you
Mm.
couple the difficulty to buy your first house and get into the for sale housing market and a lack of supply in the multifamily space, it's a real tailwind for those of us that are current
Mm.
owners in the multifamily space to not only attract tenants, but maybe even raise rents a little bit. So
Hmm.
the tailwinds are strong in the multifamily space from my perspective.
And what is your investment thesis or philosophy? Is it buy and hold forever for yield, or do you buy and look to add value and sell, or like what's your approach?
Yeah, our approach historically has been value add. So we're generally buying, doing a material value add to a project, stabilizing it and selling it. We're candidly we're looking at a more long-term hold aspect to what we do at T2, but for all of our 15 years, we've been value add investors that generally have a 5 to 7 year hold on each of
Mm.
our investments.
Oh, right. So I thought you were going to continue that. I was just
Oh, sorry.
typing the next question.
Sorry.
Okay. And so what about headwinds then? What are
Yeah.
the headwinds that you're seeing in multifamily?
Headwinds is when the when interest rates were near zero. So go back to 2020 and even 2021.
Mm.
Boy, there was a proliferation of development that took place around the United States. And so one of the
Mm.
markets that T2 has been active in is like Huntsville, Alabama, for instance, Nashville,
Right.
Tennessee. While we thought we might have been a little unique in getting out of the ground in those markets, lo and behold, there were an awful lot of people that applied for permits and had plans drawn and construction loans ready to build as well. So it fueled a bunch of competition. So as we sit today here in November of 2025, we're still feeling this glut of new development that has been developed that might have been started back in 2020, 2021, is now hitting the market or is now just recently hit the market and is now in a lease up phase where there's just this glut of supply in specific markets.
Mm.
And so having
Mm.
to wade through that and try to be patient and give the concessions where we need to give concessions in order to lease properties up, that's been a challenge. That's certainly been a strong headwind in multifamily.
Mm.
Again, I think that'll turn 180 degrees here pretty soon as
Mm.
there's no new supply coming behind this. Again, the
Mhm.
unattainability of a new home for a lot of people. So it'll flip, but in the meantime, we're dealing with a supply glut in the multifamily space.
And what about student housing? What are the dynamics in student housing?
Students fascinating.
Mm.
I love student housing. Frankly, I have a bias toward. I have a couple kids in that teenage, young 20s sort of age group, and
Mm.
so I love college students and just working with them, trying to make housing markets cool and just figuring
Mm.
out what resonates with them, so that they want to lease a unit or a bedroom within one of our properties.
Mm.
Student housing, a lot of people paint it with a broad brush, but it is far from a broad brush. There's this incredible bifurcation going on, it has been going on in student housing for a while now, and of the haves and the have-nots. There was a great article in the Wall Street Journal that really brought this home to a lot of people a few months ago. My home state of Illinois, the Wall Street Journal painted this picture of Western Illinois University contrasted with the University of Illinois. What's going on there is what's going on as a microcosm around the country, and that is Western Illinois is really struggling to attract applicants to the school. Just a real lack of demand that they're
Mm.
confronted with, such that it's dwindling their resources, monetary resources, considerably, just to give away scholarships or try to induce demand at Western Illinois. On the flip
Mm.
side, the University of Illinois has been flooded with applications from around the world, and they're a STEM oriented school. It's a great education. The job prospects for those graduates is very high. And so they've got this enviable position of being uber selective with their applicants. And
Mm.
so that's again a microcosm of what's going on around the country is these haves and
Mm.
have-nots, where
Really?
these STEM oriented, often state funded, high
Mm.
culture schools, I would go so far as to say it's an interesting dynamic. But even schools with all you have to do is watch a football game or a basketball game or a volleyball game or something like that, and you get a feel for the culture of the school.
Mm.
Those schools, it's an interesting indication where those schools are thriving and students want to be there and a part of that culture, versus other schools where, again, it's really hard to drive applications without giving away, big scholarship numbers and dwindling resources at school. So just being very, very mindful of the evolution of colleges and universities around the country for who's going to make it long term.
Interesting. That is interesting. So the impact. Oh no, all right. So any actually, let me move to this topic that I was going to ask you about before I alluded to before. So I'm going to jump off student housing and multifamily completely. I usually try to segue in, but let's just jump to one thing that you said that's really interesting and that I think sets you apart actually. And that is that your primary capital channels are the RIA channel. That is very unusual. A lot of sponsors would love to get into those channels. They are notoriously difficult to get into. So talk about what makes T2 different that attracts RIAs who have this resistance really to to anything that isn't straight down the middle of the fairway, frankly.
That's a great point.
Mm,
I will say it's not an easy road. Yet we
mm,
see a lot of the big publicly traded, Wall Street oriented private equity shops trying to get into the RIA space, which is fascinating
mhm,
to me.
mhm,
RIAs historically, like you said, Adam, have been reticent to branch on, even branch beyond the traditional 60-40 portfolio of stocks and bonds. To entertain alternatives, let alone to make allocations to alternatives, has been groundbreaking over maybe the past decade or so. It's certainly much more widespread and adopted at this point, but 10 years ago, it was a relatively new concept that we were starting to back into. I think where T2 differentiates in our ability to
mm,
kind of break down some walls and to get into the RIA space early.
mm,
I hate to really boil it down to something simple, but I think it's two things. Number one, I think people learn to trust us. We're
mm,
just people. Like I said earlier, we're trying to be uber transparent with our reporting, the goods, bads, and difference within our portfolios. Very adept at just meeting with folks, whether getting on a plane and meeting with somebody on short notice, but just whatever we need to do to foster trust is something that we work really hard at doing and then sustaining that trust. Secondarily, it does come down to results at the end of the day, right? I mean, I can trust you, I can invest with you, but you still got to deliver. And so
mhm.
we have delivered through the years. And um, so that separation on returns and trust, at the end of the day, it's a relationship business like so many other businesses around the world, and we've thrived in that setting. I don't take that lightly. Our integrity is top of the list as far as what we espouse to be known for here at T2, and then we match that with delivering returns, so it's a really simple formula at the end of the day.
So typically, how do RIAs invest with you? Do they make introductions to their clients? Do they set up their own entities? I've seen all kinds of structures, but never anybody that has said most of our capital comes from RIAs. So what are the typical patterns that you see?
Yeah, and we see it all over the place. And
Mm,
it's a good catch. We see the feeder funds from an RIA where the RIA will set up a new LLC and just have all of their clients or whomever they deem appropriate sign up for this LLC, and then we get one check from the LLC at the end of the day or
mhm.
one wire. We've seen
Right.
the other end of the spectrum as well, where the RIA might say, "Hey, listen, this is great. We're going to advocate for you guys to our
Mm.
clients." And then we get individual subscription agreements from each of their clients as well. So that
And
leads
and
to
those will stay inside the RIA's oversight. So they're still earning
correct.
a 1% fee on whatever is being managed inside there or whatever they're charged.
Exactly right. Yeah,
Mm,
part of our mousetrap, if you will, is we are approved on the major custodial platforms. So Schwab, Fidelity, Pershing, you
mhm,
name it, we're on the platform. And so it does help each RIA to charge their wrapper fee or whatever the case is, and
mhm.
see how the performance is on each of the monthly or quarterly statements that go out.
And what does it take to be, it's not listed, is it? But to show up on these platforms.
It's a
What's
pro.
the process? It is, isn't it?
Yeah,
I
it is a
always thought it
process.
was also, it's a deal by deal process though, isn't it? Or is it company level?
We've always done it fund by fund.
Fund, okay, fund. Yeah.
Yeah, but it is a process. It's not a simple submit the paperwork and expect an approval the next day or anything like that.
Mm.
It is explanation. Here's what we're doing. Often here's our RIA advocates that are here to help sponsor it, if you will.
Huh.
Um, and so that advocacy really helps as well. But it's not quick.
Mm.
Um, it's not simple from an administration standpoint. But I would argue that it's worth it.
And is there a layer of due diligence as well that RIAs can look at, and without listening to you, they can look at their due diligence?
100%. We've there are plenty of layers anymore, whether it's with an institutional investor who might have their gatekeepers, but even RIAs increasingly have various gatekeepers and people looking out for them as well. So the
Mm.
iCapitals, the cases of the world, they will conduct very thorough due diligence, often in concert with a legal team, just to make sure that we are in fact doing what we said we were going to do.
Mm.
We are reporting like we said we were going to report. There's an annual audit from them on top of the annual audit that we already do externally.
Mm.
Again, it's involved. It keeps our investor relations team very busy, but we wouldn't do it if we didn't think it was worth it.
And is it primarily administrative due diligence, making sure that everything is set up properly, or do they dive into deal level due diligence and yeah, this is a good deal and that one's not, kind of thing?
Uh-huh. Yeah, it's both. It
Mm.
certainly starts as a process oriented, talk to me about
Mm.
your back office, talk to me about your checks and balances, talk to me
Mm.
about how money moves within your organization, who has to
Mm.
provide approval and when.
Mhm.
But then it transitions to once that box is checked, let's go through the portfolio asset by asset and tell me what's going on here. And again, good, bad, or
Mm.
indifferent, just being open and transparent is what we have found that works.
Um, and by the way, if there's any questions you don't want to answer, just let me know. Just
No,
feel free. So I'm
appreciate
totally
that.
fine with that. Nobody minds. And I certainly don't. So there's an executive order recently that opened up retirement accounts that suddenly a lot of tourists immediately thought was going to involve an enormous flood of capital into their uh, poorly underwritten deals. He said. So what has been the impact of that? First of all, just describe exactly what I'm talking about, if you don't
Sure.
mind, and then and what is the impact? Is there any impact on shops like yours of that?
Yeah, there's certainly an impact.
Mm.
The short version of what's gone on in the United States, so I think President Trump really initiated this notion of
Mm.
private assets being held in people's 401k and other defined benefit plans,
Hmm.
which would be to unlock the 401k market into private assets. I mean, 401k market is trillions and trillions of dollars.
Hmm.
And so that would be a unique feature that 401k investors have not had historically. So
Mm.
traditionally, they've been back where RIAs were several years ago, which is the 60-40 mix, stocks, bonds, ETFs, and whatever in
Right.
there, but never alternative private assets.
Publicly traded, basically.
Correct. That's
Yeah.
right. So there is this opportunity before us that has
Mm.
attracted a lot of attention, a lot of tourists
Mm.
in the space that are trying to glob onto some assets there. I'll tell you, and I'm going to talk against our own book here. While I
Mm.
welcome the notion of bringing 401k assets into the private markets, I do think there's a very deep, clear message that needs to be taught to these prospective 401k investors who are considering investing privately into illiquid securities. And that is that, listen, if you have something come up and you need immediate liquidity, it's likely naive to expect that the liquidity is there unless the fund might have some liquidity just sitting on the sideline waiting to be utilized for investors that need it. But these assets in real estate, in venture capital, in companies that people are doing leverage buyouts for, these
Mhm.
don't trade instantaneously. They don't trade every day. It's a long process to get to not just liquidity, but desired liquidity. Anybody can fire sale something, but if you want a desired outcome that's going to match and hopefully hit some return thresholds and expectations that people like T2 had set externally with investors, it takes time. And so that's where my concern lies. Is I just want people to be fully aware of the illiquid nature of these private investments and uh, you know, and embrace it. And I'm not to say yes or no if 401k should be in private assets, but there's got to be a deep understanding of just how liquid these underlying assets are.
Well, and also, so what I was also still haven't, well, trying to figure out or explain more clearly is that as a 401k holder or with the defined benefit plan, whatever whatever
Yeah,
retirement plan you've got, it's not like you're going to be able to say, okay, I'm going to invest in, the guy's project next door. So in what way to investors, how are these opportunities going to manifest? How are they going to show? Right to
yeah,
them, like how is it going to how are they going to make those investments
yeah.
actually?
I think that's kind of the $64,000 question, Adam. There's a
Yeah.
lot that still warrants clarity. I
Mm.
don't have that clarity at this point.
Right. Okay, good. I'm glad because then it's
Yeah.
not just me. I think it's coming from these are institutional, these are still massive institutions
Yes.
that are going to be offering instead of an index fund. By the way, probably somebody listening that knows this is going to realize I really don't know what I'm talking about, but like an index fund or a mutual fund, it's going to be some kind of fund in which is also held private
Yeah.
equity real estate or private capital
Sure.
investments. So it's still going to have a big, like a, major institutional stamp on it. It's not like
Yes.
a
Yes.
sponsor down the road is going to, you suddenly, oh, I want to invest with them. I'll put my 401k into that.
For sure. And no question about it. I think part of the trouble lies, and
Mm,
I respect these large firms that'll put their stamp of approval on something, whether,
right.
even T2 or otherwise. But I, I tell you what comes up quite a bit, and I see it more in the private equity world where
Mm,
these large funds buy stakes in companies, and they'll often have, one company will be owned by a multitude of private equity firms. They syndicate it among,
mm,
these big household names in private equity that we all know.
mm,
Those companies don't necessarily compare notes when it comes to marking to market the value of their stake in that company every month or every quarter or every year for that matter. So you can have the very same investment. You and I own XYZ company,
mm,
uh, but one of them might market at you know 110 cents on the dollar. Another might market at 120 cents on the dollar. Well,
mm,
what's the real value? Well, again,
mm.
this is where illiquidity comes into the mix. There's not this active, fluid, liquid
Right.
market that's telling you what it actually is worth right now.
Mm.
It's an opinion at the end of the day. And until the property or the company sells, there is no crystal clarity on what it's worth. And that's again, that's the silver bullet out there right now from my vantage point that needs to be resolved in order to really unlock things on the private equity world.
Jeff, you've still got a bit of time to chat for a few more
I do.
minutes.
Yeah.
Okay, good. So let's move back to investors and talk about investors. So the economy has changed a lot and is continuing to change in the last few years, particularly, well, since ZIRP ended, since zero interest rates evaporated and interest rates went up and the market started to, commercial real estate started to bottom and then a lot of uncertainty today. We've got the Supreme Court, debating tariffs. I mean,
Tariffs, right?
where the heck that's going to go? It's right at the moment. So, what have you found are what are investor trends? I mean, you've got almost 2,000 or 2,000 investors. You
Yeah.
It's good insights into
Yeah.
what's going on. What are the investor trends that you're noticing over the last few years and today? And are you finding that they are active at the moment, actively looking, or reserved at the moment?
A couple things stand out to me on the investor side. Number one, I would say investors want experts. So, like for us
Mm,
to go back to our verticals of bridge lending, student housing, and multifamily, that has come through years of us doing a multitude of other property types and investment types and whatnot, getting feedback from our investors to say, hey, listen, I like what you're doing, but man, I really appreciate your expertise in the student housing space or something like that.
mm,
So being an expert in the field, I think really carries a lot of weight. Just to give you another quick statistic, I saw something the other day that in the broad universe of private equity, so far beyond real estate, there are more private equity firms in the United States than there are McDonald's. Just to put that in perspective, it's crazy.
No,
Yeah,
that
no.
can't be true.
I'll have to send it to you after this.
There's a McDonald's on every corner. There can't possibly be a private equity shop sitting behind it somewhere.
Doesn't make sense, right?
That's
But
incredible
so there's
statistic.
you know no shortage of flavors out there of private equity and whatnot. So
Right.
for us, what we
Mm,
have seen resonates with investors is being an expert in a very specific field. So being very niche in that regard. The other
mhm,
thing I would say is uh, more on the institutional side, and even with RIAs, there has been such an illiquidity, going back to that theme a minute,
mm,
over the past 2 or 3 years. So coming out of 2020 and COVID, interest rates at zero. Suddenly in 2022, interest rates start running. And we're getting 75 basis point increases every time the Fed meets,
mm,
where we saw this, 500 plus interest rate, 500 plus basis point interest rate
mhm,
increase over, 12, 18 months. Well,
mm,
that has really hampered sales or dispositions in the real estate space, which has
mm,
then led to a lack of liquidity from these major investors
mm,
in that space. Well, when it comes time, folks like T2 or you name the private equity firm, when they go back out to market to try to raise the next proverbial multifamily fund or private credit fund or something like that,
mm.
a lot of the feedback that comes is, listen, I like you guys, I trust your
Interesting.
strategy. However, I just don't, the endowment or the foundation or the pension
Right.
fund, or I don't have the liquidity right now to give
Mm,
you a meaningful commitment. And so the investor need, liquidity to be unlocked. I need these assets to sell, these companies, these real estate properties. I need them to sell. I need liquidity to come in the door before I consider re-upping for the next fund. So
And
that's a real issue right now.
does that apply, Jeff, also to individual investors, you're finding?
Not near as prolific.
And so what's the issue with individual investors? My guess is,
Okay.
first of all,
Well,
I'm assuming that uh, that I'm assuming that you've probably had some challenges, but you've not had the challenges like the total fails. You wouldn't be sitting here
fair.
talking to me if that
No,
was
of course. Right.
right. So the point I'm making is that of your 2,000, I also imagine, it's just wildly guessing, but of your 2,000 investors, they weren't only investing with you, and that they've probably been exposed to some losses elsewhere that's also making them reticent. I don't want to put that idea into your mouth, but that's the direction I'm going in. Is that something that you have seen and are sensing, that people have lost money, had distributions stopped, or had capital calls they don't know what to do with, and that they've lost faith in some degree in real estate?
Yes. And I'm glad you brought that up, actually. And it's
Mm,
top of mind for me. Just had
mm,
a lunch meeting last week with one of our larger investors, a large
mm,
family office. And they shared about how, when they do their internal reporting, you know, I can tell you about our losses and our lessons learned for years here, but I'll profile a win for us. They said T2 is on the cover of their investor reporting when they share among the family and whatnot, because we are their only real estate fund that has made money for them for the past couple of years. And
phew,
so certainly, even though that we're performing for them, they trust us. We all get along swimmingly. To your point, their their losses that they have endured on other real estate asset classes definitely sours them on the notion of doubling down on real estate, or whether it be T2's next fund or anybody else's for that matter. But
mm,
there's definitely a domino effect. So
mm.
there's real reason to cheer for our peers in the industry, because we all benefit when there's confidence in the space and investors do in fact re-up for the next fund.
Yeah, it's interesting because it's the same kind of challenge. We were talking about you were talking about competing for debt placements. You've got folk
Yes.
out there. The flip side of that is you're competing for equity capital. You're competing for investments that other people have soured. That they've
Yes.
soured the well, or whatever you want to,
Yes.
poisoned the well a little bit.
Yes.
So how do you adjust for that? Okay, so I'm going to share with you my view for where we're headed as we start to wrap up here. So we're getting close to wrapping. So, few things. I just have. I mean, look, I'm an eternal optimist. Earlier this year, especially after Liberation Day, I just thought the world was about to implode. But I wasn't the only person that thought that.
Right.
Now I think actually that we are likely to see a tremendous boost to the real estate economy, to the economy in general, particularly to real estate. Alvarez and Marsal, they put out a report about deregulation, releasing $2.6 trillion. When you come out of the global financial crisis, $2.6 trillion of lending. Interest rates are going to come down. I mean, whether it's before or after he's turned out, it's going to, in May, when Powell has turned out, interest rates are going to have more liquidity. and lower interest rates. It's just going to act as a fillip to the industry. It's going to be a good, a tremendous opportunity. There was one other thing, I forgot what it was. Three things anyway that are driving optimism for real estate with long-term caution, right? That we aren't just going to
Sure.
inflate a huge bubble.
Yep.
So, with this reticence that you are hearing from your investors, anecdotally, this family office that you spoke to yesterday, how do you adjust for that? Number one, and two, do you have the same degree of optimism going into 26 as I do for the same reasons?
I do. And I think your optimism for 2026 is well founded. Frankly, there was a lot of optimism going into 2025 coming out of the election. It's interesting with President Trump. We can all say we've seen this movie before. Like we know where his core policies are and what his core beliefs are from an economic standpoint. The guy's a real estate developer at the end of the day. So he wants what's really good for the real estate market.
Mm,
Low interest rates, the lack of red tape on development. That's all beneficial and should provide a fair amount of
mm.
just tailwind behind the real estate space. So I share your optimism for 2026. On the flip side, yeah, in the meantime, while we're dealing with these family offices, institutional, individual investors that are licking their wounds and don't have the liquidity that they would like from investments that they made 3, 4 years ago, it does cause for some adoption. And maybe part of that solution is the unleashing of 401k assets into private and alternative funds. I would say some of it as well is you gotta be patient. While we might have aspirations for $1 billion fund in 2026, maybe it'll be much smaller, and we just gotta make the most of whatever smaller
Well, how
allocation
are
that
you
we get.
adapting though? I mean, how are you adapt? If you have this confidence, I certainly do. And you've
Yeah,
talked about having a long-term perspective. We'll wrap up on this. I
sure.
noticed you looking to one side. Probably got a huge clock over there.
Oh, you're okay. No, I'm
He's
sorry.
like, he's
No,
looking at the clock.
far from.
We have this degree of confidence. We've been through it. We know what's going to happen. It is a movie that we've seen before. I can't help but think of, look, any real estate developer, if you had the power, what would you do? You'd make it easier to get loans at lower rates. That's what you do, right? And so if you're the
100%.
president, that's what you're going to do. But
Yeah,
you also know that if you're sensible, you also know that inevitably that is going to inflate the market and there's going to be a precipice at some point. So you got
yeah,
to think long term. So when
yeah.
you're talking, so what is your approach when you're talking to investors like you spoke to yesterday? You didn't throw your hands up, presumably, and give
No, no,
up,
no, no.
right? Okay, all right, I understand. So, we know you're not going to invest. So how are you adapting your approach with investors? And not perhaps strategically and pragmatically in terms of the actual way that you make your investments, but also in terms of the way that you communicate your confidence and optimism to overcome these, kind of perceived hurdles that investors have based on the negative experiences they've had.
Right. Yeah. It's just like you're saying, Adam. It's nothing short of just being uber transparent with them. Like here's where we're at. Here's what we've delivered. Here's what we'd like to do. Here's the foundation for our optimism looking forward.
Mm,
All the reasons that you're citing. If that investor then has some
mm,
impediment to investing with you, it's a little bit of, man, I'm sorry. I want to make this worth your while. Maybe that investor agreed to fund $500,000 with us in the past. Maybe now they can do 250. Great. Let's high five and celebrate those things. But so that's where I'm saying it's just the adaptation for us to say, listen, we have 2,000 investors. We can manage, a heck of a lot more uh, because they've historically have come to us in small chunks. We don't have the luxury of somebody that has written the $100 million check with us, and so now we're really beholden to that large institutional investor. And if they change their mind, boy, that changes T2's business. We have just the opposite of that, where we have a ton of flexibility to say, okay, we have 2,000 investors. They've given us $1.4 billion. So we're going to be really smart with how we deploy that. But if those 2,000 change their mind and suddenly we have 700 million, hey, our sales team is charged with let's open up some new doors. Let's foster trust with other RIAs and other investors around the country. Let's take smaller checks if we need to take smaller checks,
Mm.
and just continue to tell our story, continue to be authentic, continue to be honest, and whatever happens, happens. I don't mean to throw up my arms in any sort of regard, but I'm not going to pretend to control the macro climate either. We're here to make money for our investors and communicate extraordinarily clearly. That will never stop, regardless of market conditions. And so we're just going to, take it a day at a time as the market evolves.
What is your minimum investment?
$100,000.
Okay. Let's wrap up with one final question. Okay, so what are the key signals, Jeff, going into 26 now and going into 20? I mean, there's so much going on. It's like, I'm not a big sports fan. I used to be when I was growing up, but I'm not really these days. I actually get an enormous thrill about, I know this is going to sound really sad, watching and listening to Supreme Court arguments. That it's
Wow.
absolutely fascinating.
Yeah,
It's
yeah, good
truly,
for
you can
you.
go to oyez.org, oyez.org. You can listen to all of them historically. It's all the way back to the 50s. It's incredible. To me, it is the DNA of America. And so
Yep.
to be able to follow some of this stuff almost in real time is fascinating. So there's a lot going on at the moment, as you know. What are the key signals that you watch that
Yeah.
listeners and our viewers can learn from and follow as well, perhaps, that inform you about where the market is headed? It's my last question.
Yeah. I think everybody in real estate will tell you they follow interest rates, and interest rates is obviously a very broad term. I think
Mm,
following the 10-year Treasury yield is particularly relevant.
mm,
So as that trickles down, that inspires confidence in real estate developers and investors. So that's number one, and that's widely understood. We'll take it a step further. Very closely follow employment data, and of course that's
mm.
been non-existent for like 40
Little
days now, right?
challenging,
Yeah.
right?
So we're highly dependent on groups like
Mm,
ADP and other payroll
mhm,
providers to
mm,
give us whatever anecdotal evidence they have about where the employment market is, because I would go so far as to say there's no single macroeconomic measure more important to real estate than employment data.
mm,
Um, so employment data really, really matters. And then
mm,
the last thing I would say, and it gets a little bit granular, is
mm,
there are properties on the market right now that are available for sale. How many bidders are actually showing up and bidding on properties right now?
mm,
I'll just put a plug in for Jones Lang LaSalle or JLL.
mm,
JLL does a great job of compiling that specific data and then charting it to say, here's the strength of the bid in the market right now for various asset classes: retail, multifamily, office, industrial, and then comparing that to where it was a year ago, 5 years ago, 10 years ago. And
mm.
what you'll see today, anyway, is that virtually every asset class, the one exception is modestly industrial, every asset class has a stronger bid today. There's more bidders at the market clearing price today than there were last year. That's a really healthy sign for the market.
Mm.
So those three things really consume the vast majority of what we look at, and everything else is anecdotal.
Jeff Brown, founder, CEO, and co-chief investment officer at T2 Capital Management. Thank you so much for joining me on the podcast today.
My pleasure, Adam. Thank you so much for having me.
All right, that was Jeff Brown, CEO and co-chief investment officer at T2 Capital Management. Jeff, what a pleasure meeting you. Thanks so much for spending your time with me today. You have a very interesting business there. I do like this idea of the banks of the Mississippi. How cool. Every time I hear that, all I think of is Mark Twain and Huckleberry Finn. But anyway, it was nice to meet you, and I really appreciate your time and sharing your insights into what's going on in the market at the moment. Certainly are living and operating in interesting times, are we not? And thank you to dear dear investors, dear listeners and viewers. I really appreciate you being here as well today. If you want to know more about Jeff, just go to the show notes page at gowercrowd.com. I'll include links to his LinkedIn profile, to his company. And while you're there, go ahead and subscribe to the newsletter. My newsletter comes out once a week or whenever these podcasts go out. It's totally free and you can always unsubscribe. Okay, that is all that I have for today's episode. And so until next time, this is Adam Gower signing off.